I think that what we have to do is we have to move from what I'm calling microinsurance 1.0 to microinsurance 2.0. We all started out, we spent the last several years, 15 years or so, trying to just get microinsurance out there, life products, health products. We now have to refine the way we look at these things, right? Microinsurance 1.0 was microinsurance, right? Insurance for low-income people, right? We had relatively low penetration, lots of effort at distribution channels. We have high touch, lots of explanation to clients, sit down and get financial education, a lot of high touch, a lot of high effort, cost. We have broad level products, and we've limited consumer protection, for example. Right? We took away a lot of the consumer protections in order to be able to make these products cheap, in order to make them simple, right? So now, when we look at microinsurance 2.0, I suspect within the next 5 years, we won't even be talking about microinsurance anymore, right? Rick says the key to a business case is scale. If we're going to get to scale, we're going to have to move to consideration of the mass market. And in a lot of countries, this is happening already, right? Mexico, Colombia, Brazil, some of these countries that are doing mobile insurance, the mass market. The role we have then is that we have to make sure that the market just doesn't move up, that the companies don't move up in their markets. They say, oh, look, we're doubling the number of people in a certain country that are insured. Is that all the middle income people? Is that low income people? We have to be more considerate of what that market really is. I think the larger distribution channels, this mass market, this is just going to continue, and we're going to see more and more and more of it. Where does microinsurance fit? Where do these lessons that we've learned today, where do they fit into this discussion, helping to generate more scale? We're going to have more low and high touch. If we're going to generate super scale, we're going to have to figure out ways in which we can sell these products with lower touch, lower cost. Rick also says the problem with health insurance is the problem of admin costs. I think that's a problem across the board. Life is easier, but it still has significant admin costs. How can we reduce those admin costs through these? The nuanced products, segmentation, right? We'll talk about the nuance in a minute. And more appropriate customer protection. If we're selling to the masses, how do we make sure that they're getting covered? I mean, that they're getting protected and not missold to, not getting lousy products. So a lot of the lessons that we've learned here help us in moving into microinsurance 2.0, kind of a new, more refined approach to microinsurance, okay? And business case and value. We talked about the actuary's guess. This was kind of an easy way to determine, is there value, is there not, right? Larger the difference between how much you're paying in premiums and what people are getting as coverage, that indicates great value. It doesn't work. It doesn't work. We also talked about claims ratio. We say you need a 60, 70, 80% claims ratio to show value. I think it's questionable now. I think we can see products that have some value, have good value, and yet are offered at a relatively low claims ratio. We look at funeral example in Colombia. Okay, if we look at the business case side, we've got a 22% claims ratio, 45% in commissions. This is sold through utilities. We're going to see more and more of this. These very high commissions to get access to lots of people. And that's the market reality. Over time, hopefully we'll see that decline some. But I was just in Nigeria, for example. The telecoms want 60%. That's before you do anything. 60%. This is going to become more of a reality in our business as this becomes more of a mass market. And how do we make sure that we're offering good quality products when we're paying that kind of a commission? Operating expenses for the insurer, about 15%. are making about 18% profit on this product. On their normal life business, the rest of their life business, they're making about 35%. So they're recognizing that if they get huge volume, they can make the kinds of profits, okay? But clearly, previously, I think we would have said, no value here, 20% claims ratio. Clients aren't getting enough back. But we look at what's really happening on the client side, right? This is the source of funds for clients related to this funeral policy. So you've got your insured here, and you've got your uninsured here. And in this case, here's your savings. You can see it's just a little tiny sliver here on the insured group. On the uninsured group, in this pool, everyone used up all their savings. They've completely depleted their resiliency going forward. Not only that, but they had very significant loans. A few loans on the insured side, very significant loans on the uninsured side. These loans come with future obligations. They come with interest rates, additional costs. We also see significant reduced consumption. Right here, very thin layer, reduced consumption. This is reduced nutrition in the household, taking your kids out of school. Right? We can see, in this case, tremendous benefit here. I would say that this is an extremely valuable product for those people who make claims. Okay? So I would say this is a good value product, and this is what it costs to get that product out there. We have to think about this a little differently. Some of the key things that are going to change that, expanding distribution and the competition that comes along with that. As there's more competition, as distribution expands, some of this will be improved. Some of this commission will be improved. But right now, there are relatively few institutions or few organizations in any of these countries that reach millions of people. And insurers, of course, want volume. And scale, of course, is what drives profitability. Okay? So the mass market itself, technology. Technology will help us to reduce our admin costs. And this is going to be incredibly important. Finding better ways to use technology to reduce our costs. Not just mobile phones to sell insurance, but how do we transact more efficiently? These are going to be keys. The costs of education, we still have to make sure people understand what they're buying. We still have to market products. We still have to have simple products, but simple products of value. And the consumer protection issues. Time, evolution, competition, all may bring improvements to this, because we, of course, don't want to see continued commissions like that. We don't want to see claims like that. You just saw the example that Rick had of the Philippines. We'll talk about that in a minute. Okay, we have another example. It's a health policy from Kenya. Here you've got claims ratio 104%. Claims costs were more than total premiums collected. Okay, you got a relatively small commission here through the tea farmer organization. Operating costs for the institution, the insurer 35%. 35% because it's health. You have more transactions, right? Okay, in this case, a minus 52% loss, 52% loss. Okay, and here when you look at the value, so the business case here really isn't any at this point. Significant changes would need to be made to make this work. If you look at the value side, right, you look at, here's income usage, here's formal loans, a little bit less, gifts, reduced consumption, more significant, maybe reduced consumption because they know the insurance will pay some, and so that's an easier, less burdensome mechanism. But overall, the cost is not so much different between the two, about $75, or that would be what, about 25%. Cost is not so much different. So you have a claims ratio. It's not good at all for the insurer, not a business case. And you have a product that maybe is a bit marginal. So we don't always see good balance. And thinking about this balance, the magical balance as I'm calling it, right, is what we have to get to, is where we have value for clients, and a good business case for insurers. Okay? Let's think about this myth. Insurance is the answer to risk mitigation. We used to go around and say, oh yeah, if we get insurance, then people will have their risks taken care of. As Barbara showed us, insurance doesn't ever cover everything that clients need. They respond to risk in an environment of risk mitigating activities. Credit, savings, friends and others, right? We have to think about, where does microinsurance fit? Rather than just microinsurance is the answer, where does insurance fit into these other mechanisms? How do we fit with savings, with credit? How do we fit with remittances? How do we make those services more efficient and effective at risk management for clients? We have to remember that microinsurance is a piece of the strategy. People will continue forever to use other mechanisms. Let's help them to look at the financial inclusion issues, not just insurance, but the range of products, so that they can better respond to risks, better mitigate their risks. And we can only do that if we have a good understanding of their financial behavior. Okay, I want to come back to a need to move away from kind of a broad life insurance kind of policy perspective to more of a response and service perspective, and kind of what a good market is. We still have to have S.U.A.V.E. market products, S.U.A.V.E. products for microinsurance. S.U.A.V.E. is simple, understood, accessible, valuable, efficient. Good microinsurance products are S.U.A.V.E. So we have to work on developing these products, and where we see a very good example is, again, to go back to the Philippines. Rick talked about a couple of these already, right? So you've got insurers making a bit of money. You've got claims ratio that's been growing 21% to 46% over the last 5 years. You've got a market that has increased by 250%. You've got distributors that have increased, made profits by about 8%. This is a perfect country. It's kind of a perfect storm for microinsurance. This will continue to massively grow. Clients will get better value, because in the Philippines now, the competition is not about price. Competition is about service in the Philippines. And I think many, many countries are going to follow this kind of a path. This is a forerunner. It's an advanced look at what's going to happen with microinsurance. As more insurance companies get into microinsurance, they get serious in microinsurance, we're going to see this kind of competition. We're going to see these kinds of markets. Okay, in the Philippines, why does this happen? It happens because distribution is available, demand is growing due to service, not price. Public efforts in improving the environment. The government has said they want the Philippines to be the microinsurance capital of Southeast Asia. And so they've made a lot of efforts to make that happen. Not by mandating insurers to go into the business, but by proving, showing what's a good product, by doing market education, by creating a logo that people put on their microinsurance policies, and then promoting what that means. They've made a big effort at facilitating microinsurance. And competition. Competition has had a tremendous impact. As we have other countries with competition, we're going to get better products, and yet at the same time, competition is not killing profitability. It's helping the business. It's growing the business. This is really, really important. And I think that's about it. Drink milk for better microinsurance. Okay? Thank you. So